All right, so we've talked a little bit so far about unearned revenue liabilities, and we have a little bit of a different situation here. Some of our terminology is going to change slightly because we're dealing with a non-profit organization here. But all of our principles are going to be the same, just a little bit of the terminology is going to change. So let's get started here. The Metropolitan Opera Association was founded in 1883 and is widely regarded as one of the world's greatest opera companies. The Metropolitan's performance run from September to May, and the season consisted of more than 24 different operas. What a deal. Many of the opera's loyal subscribers purchase tickets for the upcoming season prior to the end of the opera's fiscal year end at July the 30th. Okay. In its annual report, the Metropolitan recognized a deferred revenue liability. So I want to stop right here. Deferred revenue is the same thing as unearned revenue, but in governmental accounting and also in nonprofit, it is a little bit more common to hear the term deferred revenue. I will tell you that sometimes you'll hear the term deferred revenue even if we're dealing with a for-profit business. So those terms are somewhat interchangeable. So they recognize the deferred revenue liability that is defined in their footnotes as follows. Advance ticket sales. Anytime you see this terminology right here, advance sales of some kind, you're going to have unearned, or in this case, deferred revenue, representing the receipt of payments for ticket sales for the, let's see here. They're just messing up all over the place. I caught one earlier. This should say next, not net. Opera season, for the next opera season, and these are reported as deferred revenue in the consolidated balance sheets. Okay. Ticket sales are recognized as box office revenue on a specific performance basis, and that is actually the way that we would do this. You know, part of that advance payment, you know, it's a big number altogether, but as each one of these shows is then performed, a portion of that deferred revenue becomes regular revenue. So they have some information for us here in the boxes for, looks like, 4-year period. And they've given us revenues that have been taken in, and then they have a deferred revenue portion. Now, they want us to recreate the journal entries to recognize ticket sales for the opera's fiscal year 2017 and advance sales for the fiscal year 2018 season. Okay, so notice we don't have any information here specifically pertaining to 2018, but actually we do. Okay, so we can actually jump down here, push this up a little bit, show you how this works. We have a template here for our journal entries, and we can actually kind of piggyback off of the journal entry explanations that they've been so kind to provide for us, and we can kind of figure out in that way what we need to do. All right. So the first one in my mind is a little bit harder: to record revenue for the 2017 season. Okay. So in order to do this, we have to recognize a couple of things. That whatever we see in the deferred revenue category is basically 1 year ahead. So because we're looking at 2017, we have to go to 2016. And for the year 2016, we had deferred revenue of $46,609. Okay, and that we, deferred revenue is a liability, and liabilities have a credit balance. And we should already know that. But that was a liability for 2016. This 46,609 is going to be actually earned in the year 2017. So we're going to actually take that liability, and we're going to say, okay, it was unearned in 2016, but now in 2017 it is actually earned. So we're going to debit that to get the deferred revenue for 2016 essentially off the books, and it's going to become earned revenue. All right. So you notice also in the year 2017 we had revenues of 88,514. Okay, now here's the key on this, is that there's, we're going to take this entire amount here and we're going to do something a little bit odd, because we have portions of this that are for the current year and for the previous year, and so we can take this revenue figure here of 2018, I'm sorry, for 2017, and we can enter it in full here of 88,514. But this is not just revenues. This is revenues, let's not say plus, let's say revenues and net assets. Okay, and net assets is just a, that's net assets would be the terminology that I would prefer for stockholders' equity anyway, but that's actually the term that we use in nonprofit and governmental accounting. So what is the cash? And we should probably, if we wanted to be more specific, a cash or accounts receivable, well, it's a plug, and it is the difference between these two figures. So let's see here, 88,514, and let's see, I made a mistake there, 514 minus the 46,609 equals 41,905. Okay, so we need to talk about what all of this means right quick. Now, depending on what order you're watching this video, we have a few videos for this topic. You may already know this. If this is like the first one that you're watching, then perhaps not. So this revenue that we have here is a combination of earned revenue for the period, as well as the liability amount that was converted from a liability to equity. Remember the accounting equation, assets equal liabilities plus equity. Well, the moment that we earn this revenue here, it does become part of our revenues, but as soon as that revenue as soon as that liability decreases, equity increases, and we call that net assets. So what we have here is we actually have current year earned revenues of 41,905 plus the reduction of a liability into earned revenue of 46,609, and then in total we have 88,514. This is a fairly complex concept for most beginning accounting students. So if you struggle with that, I would encourage you to think about it a little bit. We do have some other numbers up here that you could kind of play with, and on your own paper, and see what we can do there. You could do it for the year 2015 as well as 2016. All right, and then to record advanced purchases for the 2018 season. Well, and I think maybe after we make this entry, part of what we did up here might become a little bit clearer. So the advanced purchases, okay, it's unearned revenue. We know that because they've told us, or deferred revenue. So what did we get? Well, we got cash or accounts receivable, most likely cash, for this amount, $42,649. Our credit would be then deferred. It's only one F there, I think. So deferred revenue for the same amount. All right. So I just want to spend a moment on this right quick. Back in, if we had made this if we had made a similar entry for advanced purchases for 2017, it would have looked a lot like this right here. The only difference would be the amount would have changed. So we would have originally had a journal entry, right, that was debiting cash or accounts receivable for $46,609 and crediting deferred revenue for $46,609, and then as it's earned, we then have to debit that back. Okay, so at some point we're going to have, now we don't have, for 2018, we don't have the equivalent of this figure here, so we can't actually do it. But what we could do, and I'm not going to do it because the video is starting to get a little bit long, is we could just kind of plug in, make up a number, say 90,000 for 2018 box office revenues, and then we could, we could go from there. All right, but that's all we have to do to get this question answered. Little bit heady concept, and then we had a couple of grammatical mistakes up in the scenario, so that never helps. But anyway, that's it for this exercise on deferred revenue in a nonprofit environment.